Today, a surprise drop in housing finance in April. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Well, the ABS released the latest new finance data for April, and it was against expectations, in fact, because most people were expecting a pretty solid, let's say, 2% rise following the robust 5.3% gain in March. And in fact, it went the other way. So overall, the total value of owner-occupier loans declined 3.8%. Within that, construction-related loans were down 6% over the month, and loans for the purchase of existing dwellings were down 3.4%, and the total value of first home buyer loans also dipped down 2.1%. And just to complete the set, the value of loans to investors also dropped down 0.9%. And in fact, most states recorded falls as well. So the question is this a meaningful shift, or is Easter to blame? Because, of course, Easter was in April this year. Well, it may be hard to see, but given the higher interest rates, it seems to me that there's more likelihood that people are just being a bit more cautious because the expectation now is for higher rates for longer. So it'll be interesting to see what happens next month when we get the latest data. So looking at the detail, the ABS said in April 2023, new loan commitments on a seasonally adjusted basis fell 2.9% for housing, rose 1.5% for personal fixed-term loans, rose 44% for business construction, which of course is a very volatile series, and rose 9.8% for business purchase of property, again a volatile series, so not really that relevant. Looking at the housing finance in more detail, total housing fell 2.9% to $23.3 billion after a rise of 5.3% in March. That was 25.8% lower compared to a year ago. And splitting that out for owner-occupiers, housing fell 3.8% to $15.4 billion and was 24.3% lower compared to a year ago, whereas for investor housing it fell 0.9% to $7.9 billion, and that was 28.6% lower compared to a year ago. The value of external refinancing, this is a critical measure of course, for total housing fell 9.2% to $19.3 billion after a record high of $21.3 billion in March, and it was 14.2% higher compared to a year ago. And breaking that out, owner-occupied housing refinancing fell 8.6% to $13 billion, but was still 13.5% higher compared to a year ago, while investor housing refinancing fell 10.4% to $6.3 billion, but that was 15.6% higher compared to a year ago. And it's worth making this point that the easy refinancing, both for investors and owner-occupiers, was done in the earlier part of the year. What we're now getting to is the meaty part, where in fact some of those fixed rate loans are terminating and people have to change to at least a new loan or take the variable rate loan. And in some cases, their finances are less easy, therefore the refinancing deals are less easy to come by. Now, looking at more detail in the owner-occupied housing series, the purchase of existing dwellings fell 3.4% and is now 23.8% lower compared to a year ago. The construction of new dwellings fell 7.7% and is 32.2% lower compared to a year ago. And the purchase of a new dwelling fell 2.9% and was 22.3% lower compared to a year ago. Looking across the states, New South Wales for owner-occupier housing fell 5.1%. In Victoria, it fell 1.9%. In Queensland, it fell 1.8%. In the ACT, it fell 5.3%. In the NT, a volatile series, of course, fell 20.6%. Western Australia fell 1%, and Tasmania fell 0.1%, and South Australia fell 0.01%. Looking at the investment new commitments, New South Wales fell 5.1%, Victoria fell 7.1%, the ACT fell 29%, the NT fell 13.3%, and Tasmania fell 3.8%. The ACT and NT series, of course, are typically smaller and more volatile. Western Australia rose 3.1%, South Australia rose 3.4%, and Queensland rose 0.3%. Now, looking at the data in original terms, the value of new variable rate loan commitments funded in the month fell 17.5%. The value of new variable loan commitments for first home buyers funded in the month fell 7.6%. The value of new fixed loan commitments funded in the month fell 24.3%. And the value of new fixed rate loan commitments for first home buyers funded in the month fell 12.7%. Now, this is a really important series, firstly because it tells you exactly what was funded rather than approved, completely different. And also, of course, more people are taking variable rate loans because the fixed rates at the time were less attractive. That may change ahead because recently banks have started to discount quite a lot of their fixed rate loans, although that's now changing again because the expectations of future rates has gone up. Now, in April 2023, in original terms, the average loan size for owner-occupied dwellings, including construction, the purchase of dwellings and existing dwellings, rose at a national level from $577,000 to $585,000, and it's still 21.8% higher compared to the pre-pandemic average seen in February 2020. Now consider that in the context of incomes not growing in real terms because of high inflation, and you can see the problem that's ahead. If we look at first home buyers, in seasonally adjusted terms, owner-occupied first home buyers, the number of new loan commitments at national level fell 0.9% to 8,079 after a rise of 16.5% in March, and it remains 16.2% lower compared to a year ago and 50.6% lower than January 2021, which was a high. In Queensland, they fell 3.9%, in Victoria 2.1%, in New South Wales they fell 1.2%, in the ACT it fell 6.9%, in the Northern Territory down 4.3%, and in Tasmania it fell 1.4%. But in Western Australia there was a rise of 5.4%, and in South Australia a rise of 3.7%. Turning to business finance, in the April 23 seasonally adjusted series, the value of new loan commitments for the finance of construction rose 44% after a fall of 18.3% in March. In trend terms, it just rose 2%. And for the purchase of property, it rose 9.8% after a fall of 0.9% in March. In trend terms, it rose 0.3%. But these are such volatile series as to be, frankly, meaningless month to month. And by the way, looking at personal finance, in April 23, in season-adjusted terms, the value of new loan commitments for total fixed personal finance rose 1.5% after a fall of 3% in March. For road vehicles, it rose 0.5%, but for personal investment, it fell 5.1%. So one of the things we are seeing is more households reaching for additional credit to try and bridge their financial cash flow pressures at the moment. We expect this to continue in the weeks and months ahead. And of course, the HIA came out swinging, saying the supply of new homes is set to continue to decline under the weight of rising interest rates. That's according to the HIA's senior economist, Torn Devitt. The number of loans issued for the purchase or construction of a new home have fallen to a new low, they said. The last time so few loans were issued for the purchase or construction of a new home was in September 2008, when the GFC caused a contraction in building. Lending for the purchase and construction of new homes in the last 3 months to April 2023 was 31.5% lower compared with the same time last year. There are very long lags in this cycle, and the full impact of the RBA's rate increases are still to fully hit the housing market, let alone the broader economy. These low lending numbers reflect a lack of new work entering the pipeline at the same time that population growth is surging. There needs to be a structured increase in the number of homes being built across Australia, a fact recently acknowledged by the RBA, the HIA concluded. And finally, I thought it was quite interesting that Westpac came out today saying that uncertainty around the data, including the national accounts and the labour market, makes the RBA likely to hold next week. They wrote, the Reserve Bank Board meets next week on June the 6th. The meeting is live in that the case for a further rate increase is likely to be seriously discussed. However, they say, we expect the board to decide to hold the cash rate steady at 3.85% while continuing to emphasise its tightening bias. The line, some further tightening of monetary policy may be required to ensure that inflation returns to target in a reasonable time frame, but that will depend on how the economy and inflation evolves, is likely to be repeated in the governor's statement following the meeting. Note that the qualifier may be required was used despite the minutes for the May meeting, showing that the board had become more concerned about a range of issues, including immigration, house prices, and the inflation forecast being only to reach the top of the target range by mid-2025. Since the May board meeting, they said the governor has been publicly voicing more concerns about inflation risks, particularly relating to wages. Well, my own perspective is this. It's clear to me that lending is slowing, but house prices, of course, reported yesterday, are rising, and wages growth is certainly a concern to the RBA, but of course they don't want to talk about the other, which is the out-of-cycle price increases that are being imposed quite widely by companies because they can. And all of this suggests to me that if they're serious about dealing with inflation, they will need to lift the rate again, and they will do it on Tuesday. But we'll see. But the bottom line here is that the ABS data today shows that there is a likelihood of more home price slowing rather than acceleration ahead because credit availability pumps home prices. And it's worth underscoring once again that, of course, April was a month that included Easter. And so many economists are suggesting that the drop is to do with the Easter holidays. But maybe it's more to do with the fact that we've started to see an acceleration of rate rises, whereas a couple of months ago, most people, not me, but most people were calling that the RBA had reached its peak. So it could well be that the RBA rate decisions are actually having a more significant impact on households and what they're going to do. And if that is the case, and we see more rate rises on Tuesday, that could put a further brake on household credit. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.